Good morning. Happy Monday. Welcome to the Monday Market Update. My name is Nash Paradise, and joined with me as often as I am lucky enough to see his pretty face is Mr. Andrew Cady in sunny, hopefully, Florida. Andrew, how is the weather down in Florida? Have y'all been unseasonably cold like we have up here in North Texas, or did you have a nice, pleasant weekend?
We had a very, very nice, pleasant weekend, mid 70s at night, 80s during the day. Beautiful weekend.
Okay, you should be getting our weather next then. We had rain, we had some hail, good lightning storms last night, but it was weird having a Saturday and Sunday in the 60s and 70s. We ate dinner outside last night. It was like 58 degrees. So that was fantastic. Get back into the 90s this week though. So I think the end of our late spring cool front is about to go. Speaking of things cooling off, let's talk about what's going on here in the market, because the only thing cooling here is nothing. We're all heated up. Everything is getting hot. You thought we were going to be looking into some nice de-escalation. That was the headlines all last week. Had things looking good, and it even looks like, hey, well, rates got a little bit better at the end of the week. This doesn't tell a great story. This tells some reactions and then some future forecasting around what was going on midweek, as we're talking about, a de-escalation plan and who's going to sign off on what, and all the excitement we had from last week says now we have some lower rates. But what's all not being told here?
What's not being told here is the intraday market movements. You see our volatility meter is high. So, this looks like a pretty flat chart for the week, but the volatility on just a intraday basis was pretty wild. You had reprices for the worse, reprices for the better, up, down, up, down. It was one of those weeks that if you're floating loans, you probably were a little sick to your stomach at points, and then you really felt good heading into the weekend. And then this morning you woke up and you're like, crap. It's this is indicative of wartime. Anytime we see conflict going on, the markets react in these really, really big swings, and it's often intraday swings. Sometimes the market is a flat for the day, but during the day, it's going to give you high blood pressure if you watch it.
Yeah, I think the other thing here, and the big takeaway, and just kind of where I'm getting PTSD from this is, you got something, you see a really smooth, normal trajectory all the way through the end of the day. You get your midday news, bonds are reacting one way, stocks are reacting another. And then you get to the end of the market cycle for the day, it closes, and you're just thinking, hey, cool, I got this contract in. Let me get this built out. Awesome. We'll lock tomorrow morning. And then by tomorrow morning, everything's completely new, completely different. You can have 10, 15, 20 basis points one way or another. And we saw that a lot last week, where there were some more, recoveries, and there's also some more give it back. You wake up and you see plus 25 bips. Next thing you know, it's plus 2. Next day, it's like, oh, great, we lost 18. Well, now we're back to even. It's a lot of back and forth. It's a lot of ebb and flow, and it's happening so quickly that it looks smooth. It looks like we moved in the right direction from last week to this week. But knowing what we know this morning that you don't yet, we know that it's not really the vibe, and we'll expand on that a little bit more here in just a second. Let's talk about what happened last week on econ data, because last week's economic news should have mattered. It would normally matter. This is the first week of the calendar month, which, hey, first Friday of the month, you know what that means, baby.
Jobs reports. And and jobs came in. We had ADP even came in over estimations. ADP was looking at about 100,000, 99,000 job creations and came in at 109,000. And non-farm payrolls expecting 62 came in with 115, but had a massive revision to previous months, which really dampened any reaction to that. If there would have not have been the massive revision downward from previous months, we probably would have seen a real knee-jerk reaction to that. I mean, maybe not. The markets don't really seem to care, but it basically kind of washed out this month's or last month's gains with the losses on the negative revisions previously.
Yeah, I think as you look at this, it's, non-farm payrolls, employment, labor in general. It's labor or it's inflation. Labor is pretty flat. Unemployment rate is unchanged. We thought we were going to have a large drop off in non-farm payroll, and we didn't. 115,000 is not like a gangbusters non-farm payrolls number, but compared to a $62,000 forecast, it's a pretty good hit. But with the previous at 178 and the last revision at 185, jobs are fine right now. Jobs are holding up steady. Unemployment rate's not going up. We're not seeing anything crazy happening there. Looking at the rest of the week, JOLTS jobs openings was right in line. The manufacturing PMI was right in line, a little high on ADP. It's a lot of mediocre movement in data, good forecasts or, good enough forecasts. Everything hits. No one cares. There's just would normally be great news and lots of stuff to talk about on directions of where things are going, but it's not, because this is wartime Monday market updates, and econ data is just not that relevant. Anything else you'd add on that?
No, I mean, very well said. The markets just don't care right now. We've been saying this now for, the duration of this conflict with Iran.
Yeah, week over week, nothing matters. Let's check about some other things that won't matter, which is this week. So, we've got a few things on here. We got our inflation data. So, you go from labor to inflation. Inflation, we've been having some much bigger swings on these because there's a lot of stuff moving around from March to now. And we've seen the effects of higher prices. We've seen the higher cost of fuel. It's starting to trickle down into other aspects of the economy. Is there anything that you're highlighting that you think, oh man, this could be some data that actually makes a difference?
I'm a little concerned on the consumer price index, the CPI report. Last month was 0.9% increase. And we haven't seen much change to the tune of why it would be lower. But the general consensus is that we have an expectation of a 0.6% rise in April. So I think there's a real possibility we miss that to the high side, which could rock markets a little bit. So CPI comes out Tuesday. Wednesday, we get PPI. And I definitely think there's room to miss on both of those to the high side.
Yeah, it's kind of weird. I mean, the previous CPI month over month was 0.9%. I mean, we expected that to be high. It came in high. It hit estimates. Forecasting a 0.6% on here is a little light. And I would agree with you. We do have room to be up on that. The month over month core is definitely forecasted up from 0.2 to 0.4%. Year over year headline CPI up 3.3 to 3.7. So everything's on its way up, coming down on month over month headline. I get it. We're tracking different figures there, but I can see that missing. And to your point, Wednesday core PPI, this is one where the miss could be interesting just because it is showing some pretty significant increases. Year over year PPI from 4% to 4.9, the core from 3.8 to 4.3. These are heavy increasing inflation numbers, and this is not where we want things to go. Inflation going up at this degree is not going to be, if we care about data, again, this is not going to be awesome for long-term interest rates. We need a miss on this one, and missing high, not going to be real good if we hit that direction. Do you think there's any chance that the stuff comes in and it looks maybe less impactful and that we can come in short on some of these inflation figures?
It would kind of shock me if we came in short, considering that, we were up 0.9% in March, and the conflict is still going on. We're still deep in this. So I think we could miss to the high side on it. And then we also on Thursday get eyes into, how this is impacting the consumer. Obviously, we know we're in a credit card debt society. So initially, March, the consumer wasn't impacted much. The retail sales were strong. Now retail sales, there's a huge expectation to drop off on retail sales for the month of April. So very curious to see how the consumer is reacting to this, whether we're going to continue in the society of racking up credit card debt and Klarna and Affirm everything in our life, or if consumers are actually feeling the pinch from the March and April inflation, feeling those gas prices, feeling things, and it's actually slowing down their spending.
Yeah. And I think what Andrew's saying here is, last week we had a bunch of important numbers, bunch of important econ data that we could forecast pretty effectively because we know the expenses of things going on, over a month time period. We know where the labor stuff is going. Labor is a little slower compared to inflation. This week, it's all about inflation, and spending. These things move faster. So we do have a lot of room for even more volatility this week. If we're just looking at econ data, we can miss on pretty big, margins here. And if we do by a significant amount, then we could see the markets react negatively. And this is a week that has a lot of fuel in it that can, drive interest rates up and move us in the wrong direction if we hit on the wrong side here. Now, of course, none of that can matter with a single tweet. But as we are analyzing and breaking down what this week looks like in all these forecasts, our best bet, looking forward is if these things are all going up and getting more expensive, retail sales are coming down. That should lead to, some eventually lower inflation. And, if oil can recover, these numbers recover pretty quickly too. So does it become transitory like we were talking about the tariffs about this time last year? Could be. We shall see. But for this week, we've got a lot of different days we're going to be paying good attention to stuff and making decisions interweek on, what do I do? Well, what you do is you probably just lock it because there's a lot of room for things to get worse. Not a lot of stuff on here that we can target and say, hey, this can get great. You get one good tweet about de-escalation, that's what's going to send you into a spot where it feels like, yep, let's get this locked in and protected. Everything outside of that, we're not really set up to be winning on that part.
Yeah. And also keep in mind, if you're waiting for mortgage-backed securities to move 20 basis points to lock your loan in, with how volatile the market has been recently, don't necessarily expect your rate sheets to get 20 basis points better. Lenders are not going to, and I'm not knocking lenders here, but if I was a lender, I wouldn't. If at 8 o'clock in the morning, you're 20 basis points better, and by 10, you're 3 basis points worse, and by 2 p.m., you're 20 basis points better, and by 5 p.m., you're flat, don't expect lenders to adjust their pricing 5 times per day to follow exactly in line with MBS. If you like it, lock it, because if we see the continued volatility just intraday, up and down, lenders are going to pause and say, we're not really going to move too much. And understand that lenders are very quick to reprice to the worse and very slow to reprice for the better. And that's just a general rule of thumb. It's not a knock to them, but I would do the same thing if I was in a lender's position. If I see things get dramatically better quickly, okay, let's give it a few hours and see if this thing actually holds. Let's give it a day and see if this betterment is actually going to stick or if it's going to go right back. And so if you like it, lock it. There's no point in playing games with this thing.
No, you're 100% right. You usually need a run on improvement, but if things get bad, it's going to get bad quickly. You have to establish the improvement and support it, and the forward projections have to be pointing that same direction because if everyone's worried that these 20-30 basis points are going to evaporate the next day or two, then they're not going to make those commitments to deliver that pricing at that level 30, 60, 90 days in the future. But getting into the Fed stuff, let's talk about that a little bit. Not real surprised. We've got a giant block of forecast here. No reason for anything to move to get better. And now we've got some arguments for things to move to get worse in the future. I'm not surprised by anything on here. This is kind of what I expected and what I expect for, a while now. Until we get out of this conflict, I don't see this moving in any meaningful direction. But what do you think about the, transition that, hey, our next move is going to be up, not down?
And it's a very clear shift. And I don't necessarily disagree with this. I think, let's understand. Let's take a look at, people say, well, this is just oil. Yeah, but petroleum plays into plastics, and plastics are in about 95% of what we buy. So when the cost of oil goes up, not only is it impacting your fuel prices, but it's also impacting the plastics that are built from petroleum, but it's also impacting the shipping cost of every single good that is not manufactured in the United States across the sea, but it's also impacting shipping costs on things in the country. And so this move up in oil, oh, it's just oil. No, it's really not just oil. And so this inflationary thing we're seeing is probably going to continue to bleed into all products. And this isn't going to be something, this wasn't a 30-day war. This wasn't a in and out in 2 weeks like we thought, or we were told it probably will be. This is turning out to be a much longer excursion. And now we're going to probably reap the negative consequences of it, which could look like a rate hike in the future. I most certainly hope we don't go to that, because I do think the markets psychologically will react extremely negative to a rate hike. Now, if we had one more rate cut, there probably won't be any betterment in the markets, but a rate hike signals a shift away from many, many, many months now of decreasing rates. And so I think this could be highly problematic if this continues.
Agree. You want to be smooth and steady. You want to drop until you're done dropping, and then you want to hold.
Correct.
And no one thought we were going to be holding at this 375 mark, but we are holding at this 375 mark. And, we're definitely undoing the last couple of years worth of forecasting that had this going down to 3.25, 3.0. But, at the current levels, current inflation, strong employment, like there's no justification for additional drops. Everything else in the market is impacting the overall pricing of things. And so, yeah, we're going to stay here for a while. If the longer we're in this conflict, the longer it's going to take to get into a world where we may look at any more cuts from the Fed. But I mean, inflation numbers are on a high side, unemployment staying low. We keep getting more jobs reports, but the jobs reports look good right now. So, hey, yeah, at that point, inflation becomes more important than labor. And with inflation being high, don't expect anything to come down on that.
Yep, I would agree with you 100%.
All right, well, let's talk about where we're going right now on our little nitty gritty chart here. We've been living in this range. I got real excited as we got down to that 633, and then it was gone. We've got room on both sides here, and I hate to say it, but the 10 years holding at 493. It can crush over 44. It can definitely get that 441, 442. We could keep going up, and we may very well see plus 6.5% again this week. But we could also see, 639 if something else happens that's crazy. I mean, we've got a narrow gap, which shouldn't have too much impact on buyers in the market. It's more about mortgage brokers, caring about when do I get what I really want, which is that 6% mark.
Yeah, and that's we've talked about it. The 6% mark is super psychological for buyers. I think the 10-year Treasury, obviously, we know that they don't move in lockstep, mortgage rates in the 10-year, but they do follow each other. We're in a really wide range on this thing, and it goes all the way back to March 27th. There was a Fibonacci level set where it really was like the high peak at a 448. And there's really no support right now between a 448 on the 10-year Treasury all the way down to a 433. So we're sitting in this like magical range, and it definitely seems like we're building maybe a new Fibonacci level at this 440 mark, because we've had 1, 2, 3, 4 days out of the last 7 where it's been a stopping point. So I think there is support, even though it's not chart showing right now at this 440 mark. But don't expect that. I would expect to have a very volatile week, because there's not a ton of support right now in the 10-year. One tick of bad news can easily push us up to 448 on the 10-year, where we hit another level of support, or a tweet towards the good that we're finally making progress again and again and again could drop us down to 433. But we got a lot of support at that 433. It would take a lot for us to get below 420. There's 1, 2, 3, 4, 5 levels of support we would have to break.
Yeah, I mean, just looking through a month and 3-month chart on here, the 10-year has been holding very comfortably anywhere around 4.4, 4.38, 4.37. Now, we haven't busted into that 4.5 but we can, just because we've blown through everything else. We do, like you said, have a little support showing, but we are supported right now holding 439, 438. So yeah, you get some more bad news in there. Next thing you know, we're getting up closer to those levels. That would be the highest levels we've seen in 6 months on the 10-year yield. That's not going to be great for mortgage rates. We're already a little compressed between the mortgage rates and the 30-year, overnight fixed rates. But it's been a rough 6 months when you're looking at that chart. We really need to get some control. For a while, we were holding in that 410 to 420 range, and that 420 top was a fun game. Like, are we going to get to 40 or 420 first? Well, blew through that, and we know exactly where we're going. We'll see.
To me, this 448 on the 10-year treasury is a very important ceiling if we come to that, because we have not broken above that since July 18th of 2025. That would put us, at highs for about a year, and that's something we really, really, really got to watch.
Yeah, and back in midsummer 2025, those were not great interest rates. It was not a good time. That was a hard time in lending. So we really, if we can hold mid sixes at where we are right now on this 43944, that's actually not a terrible spot to be in. But ultimately, we're going to see what the news cycle looks like. We got bad news this morning. Trump doesn't like the deal from Iran. Is he just playing the art of the deal? Is he playing hard to get? Is he just tweeting for, giggles? I don't know. We'll find out. This is something that I feel like there's enough international pressure on the situation to try to get some more movement and some more things progressing one way or another. And as that happens, we will be ready to react. But keeping the things that we can control right in front of us, we can control the conversations, we can control what people know is happening and the way that the news is conveyed, whether it's doom and gloom or, hey, here's your opportunity. That's our job as real estate professionals, is to make sure we're finding the wins for the right people. And hey, let's get it locked in. Let's find there's tons of people buying houses right now who are very happy with the 6.5%. And all the data, everything we see, does it look like we can get back down to the low fives at some point in the next 9, 12, 18 months? Absolutely. We just got to get out of this conflict first, and then, hey, see where we're going from there. The longer we're in it, the slower it's going to be. But, I see a light at the end of the tunnel, and I'm going to keep taking that positivity into my conversations and, try to find wins for people. What about you?
Always find the silver lining in everything. There's too many doom and glooms out there. We got to keep the positivity going.
Couldn't agree more. Next week, we'll check in to see if any of this econ data mattered, or if we were just truth and tweets over here and moving markets that way. But I appreciate you all being on. And Andrew and I will be back next Monday at the same time. Y'all have a fantastic week.